Hey, everybody, and happy Friday. So, as promised, I've been talking about the fact that I am going to start doing everything I can to help educate all of us on taxes, what they mean, how to understand or better understand as a taxpayer, what goes into how your taxable income gets calculated, what types of deductions or credits you're eligible or entitled to have, and things like that. So we're going to get into a lot of things and all about taxes. Okay, we have just entered into the 2024 tax filing season. And so I think all of these things that we discuss are going to become very important. If you don't already know, then consider this a refresher. But I will start taking more time and doing more work in educating and making sure that we all understand where our responsibilities lie as it relates to taxes with the government, the IRS, and all things taxes. Okay, so the first thing we're going to do, the objective of this lesson today is we're going to talk about the single taxpayer. Now, there are various filing statuses. You have single, you have head of household, you have married filing joint, you have married filing separate, you can have widower or widow. So, there are different eligibility requirements to be met based on, tax filing status, and we'll get into that as well. So the first thing I want to do is to, since we're talking about a single filer, follow along with me. We're talking about a single filing status, okay? And so we're going to talk about how that affects your tax calculations, okay? So let's first start out by defining what the single filing status is. As per the IRS, the filing status single refers to a category that determines the tax rates and standard deductions an individual is eligible for. It affects how much income tax someone owes. So that's a big thing. So we'll talk about that a little bit more as we move forward as well. Um, so the definition of a single taxpayer is an individual who is unmarried, legally separated, or divorced on the last day of the year. So we all know that the end of the year and the last day of the year is December 31st. So if you fit any of those categories in that description, then you would be considered a single filer when you go to file your taxes. Okay, who qualifies? Just, who qualifies? If you're unmarried, you qualify. You cannot be married and you cannot be in a registered domestic partnership of any kind. So, again, that's what qualifies you to be single. You can be divorced or legally separated by the last day of the tax year. We talked about that. And but you cannot be qualified to file, like the head of household status or any other, filing status. So you must meet all of those criteria in order to legally be eligible to file as a single filer. Okay. Tax implications, and this is where things get a little dicey. Um, so a single taxpayer generally has higher tax rate than those who qualify to file jointly with a spouse, but receive a lower standard deduction than a head of household filer. Okay. So for 2024, when you file your taxes this year, your standard deduction, if you are a single filer, is $14,600. Okay. Now, let's put that into a little bit of perspective. Okay. So first, we're gonna touch base on, you know, just kind of refresh some of the things we talked about. What makes a person eligible to be a single taxpayer when they file their taxes? You got to be unmarried, legally separated, or divorced by the last day of the year, and you cannot qualify for any other filing statuses, such as head of household. The standard deduction, we just talked about that for 2024, is $14,600. If a person earns $50,000 in a year, what part of their income is taxed after applying the standard deduction for a single filer? The answer to that would be that their taxable income would be $50,000 minus that standard deduction amount of $14,600. Therefore, the taxable income would be $35,400. In simple terms, the amount of money that you made out of that $50,000 that would be taxable to you as a taxpayer would only be that 35,400, not the 50,000, because you get that standard deduction. Okay? And one of the other big questions that we often come across is far as filing statuses go and income tax brackets. A lot of folk don't understand how those brackets work. We have a marginal tax system, so the tax brackets, um, they increase in tier levels based on the amount of income. I'm trying to keep it real simple so that it doesn't get real too complicated and confusing for others. So, for example, for 2024, 10% taxes gets applied to income up to $11,600. Okay. The next bracket, there are seven tax brackets: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. So, like I was saying before, the tax rate of 10% would apply on income up to $11,600. Then there's a 12% bracket. That would be on income between $11,600 and $47,150. Okay. Then we have the 22% tax bracket, which would apply to income of $47,150 up to $100,525. Okay. And so on and so forth, as you see here. Um, Then we get into, how does the tax rate for a single taxpayer differ from that of someone filing jointly with a spouse? Well, here is the big thing here is that single taxpayers generally face higher tax rates compared to married couples filing jointly because the tax brackets for joint filers are much broader, and which means that the married couple can earn more income before they actually get bumped into the next higher tax bracket. Okay, so we'll go back and look at the tax brackets here, and you'll see the spacing and the gapping. Once you hit to about, the 22% tax bracket, you see, between 47,150 and, $100,000, in income. So if you're married, filing joint, you see as the tax brackets go higher and higher, the spacing and the gaps in how much money you can earn gets broader and broader. So for married couples filing joint, they can make more money than a single person or a single filer, because more than likely, they're going to hit in this space, not just where they fall in the tax bracket, but because as a single filer, you get taxed at the highest tax rate anyway. So out the gate, you're automatically at a deficit compared to a married filing joint or a head of household filer. Okay. I hope that makes sense. So let's use an example and kind of put it into context. Okay. Here. So when we look at the application of the tax rates, right? Let's use in this scenario a single taxpayer who earns $60,000 in 2024. So what we're going to do is we're going to walk through the step-by-step calculation for this, okay, in order to calculate the taxable income. So what amount of that $60,000 in income will be taxable, okay? Now remember we talked about the fact that the standard deduction comes straight off the top. So if you take that $60,000 and you immediately deduct the standard deduction of 14,600, that is the difference. That is the 60,000 minus the 14,006, which equals $45,400. That $45,400 is the amount of income that is taxable. Simple, okay? Let's apply the brackets. So We talked about the 10%, the 12%, and the different brackets of income, right? So as you earn up and you meet the parameters of those brackets, that's when the steps and the margins start to creep up into the next tax bracket. So if we apply this same scenario to that $60,000, then this is what it's going to look like. So there's going to be a 10% tax up to the first $11,600, which is $1,160. And then there's a 12% tax on the income between that 11,601 and the 40,150. Okay. So what you do is you take the difference between that 47,150 and the 11,601, and that difference comes out to be about 35,000 some dollars, right? And then you apply 12% taxes on that $35,000 amount, or that difference, the difference between the 47,150 and the 11,601. That tax would be $4,265.88. All right. So then you sum up the tax liability based on the incremental tax brackets. So in this scenario, you would add them up. You would add up the $1,160 plus you would add the $4,265.88, and that comes out to be $5,425.88. This is the total federal income tax owed, and this is also referred to as your tax liability. Okay? So your tax liability, in a nutshell, your tax liability on that $45,400, which is your taxable income, even though you made 60,000, only 45,400 of it is taxable. And then we just broke out in step C how you're taxed at the various levels of that 45,400. Okay? So this is just a small snippet, a quick kind of tutorial on how you actually go about calculating what my taxable income is going to be. This scenario, this tutorial does not take into account any other deductions or any other refundable or non-refundable credits. This tutorial only explains and walks you through how to actually get to what your taxable income is. And I think that is a very important piece of a taxpayer understanding how taxation works. This is very elementary. It is as simple as it can possibly get. And we're starting here with the single tax filer status. We're going to walk through a head of household status. We're going to walk through a married filing joint status so that you can see the various differences and the changes, and we can do some comparisons and say, oh, okay, well, now I understand this better. And that's what I'm here to do. I want to help you better understand taxes, taxations, and how those things impact your ordinary life. I hope this is helpful, and I would like to ask you if you find this helpful and you would like to see me bring more tutorials of this nature to you all. Please follow me on YouTube. I'm at It's Just Me, Dr. T, and please subscribe to my website at www.tsjfinancial.com. I'll see you soon. Mwah.